Welcome to Digital Asset News, or DAN for short. My name is Rob, and today we're going to talk about a couple of factors that have come in. PPI numbers came in. They were a little bit hotter than expected. Then we're going to take a look at the Fed, what the Fed pivot actually is, and how there's some data that takes a look at it and says that even when the Fed does pivot, it doesn't really make a difference for quite some time. And then we're going to go over all those things, macroeconomics. Then we're going to get to the good news, which is just how I see things. So first things first, welcome. Appreciate everybody stopping by. And as you may have seen over Twitter or YouTube or wherever you get your news from, maybe it's me, today, PPI numbers came in a little bit hotter than expected. They thought it was going to be 0.2%. And as a reminder, these are the producer price index. And tomorrow we will get the consumer price index. The producers are the people that actually buy and sell things as far as like materials, energy, all those sources. And of course, the consumer price index is what we have to pay. So this is just a indicator as to what the CPI could potentially be tomorrow. And if you think about it, well, it makes sense. It'll probably be a little bit high because PPI is high. And of course, if the producers have to pay a little bit more, we probably have to pay a little more. So we're at 0.4%. The expectation was 0.2%. That was the forecast. Came up a little bit hotter than expected. And we can break it down here that the final demand, as far as this is September, because we're in 2022, even though we're in October, got to take a month to look back. Final demands, 0.4. Foods was plus 1.2. Final demand services, negative 0.2 for transportation. That's great. Plus 0.1 for processed goods, plus 0.3 for unprocessed goods, even intermediate demand. I don't know what that part is. Goods, that's the most important. Negative 2% for gasoline, 0.1% up for motor vehicles, pharmaceutical prep, industrial chem. I mean, just on and on. Steel mill products, down 6.7%. That's good. Diesel fuel up 9%, and so on and so forth. So I linked this in the description. You can take a look at what those PPI numbers are. And as a reminder, these are the PPI numbers are just what they are, the producer price index. But if we take a look at what we're trying to do, or what the Fed is trying to do, not what I'm trying to do, I'm just trying to make good investments. The Fed is trying to squash demand. And how do they do that? By raising interest rates because of the inflation so high. But there's a great website. It's called Trueflation, trueflation.com. It has also a link in the description as well. And what they do is they use Chainlink as an oracle to pull in outside data to get real-time data to show you what's going on with inflation. I wish the Fed would actually use this. That'd be nice. But you can see that over time, the inflation rate, and this takes a look at food, non-alcoholic beverages, housing, transport, utilities, health, and so on and so forth. And you can see that over time, the Fed has done its job. It's just that I don't know if it's looking at the right data. Back in March, we were almost at 12%. So it's not transitory. As it goes down, we can see that right now we're doing pretty good. I mean, 8%, I mean, that's not ideal, but it has gone down to where it's been. And maybe if we just keep on the same course, we can. I don't think the Fed's going to do that. I think they're going to raise rates tomorrow or when the CPI numbers come out, but we will see. And also, unfortunately for our partners in UK, it's not looking too hot for you guys as inflation just keeps going up and up and up. And I think one of those big things could be transportation, utilities. Utilities, look at that. That's an amazing amount. So that is what is going on. So expect some volatility, even though today it's kind of odd. We were down a little bit in the crypto market, but for the NASDAQ and S&P 500, they're like, we don't care. Maybe this is all priced in, like people say. We will see. And if you want to get a grasp of as far as like what the Fed pivot is and what they're trying to do and the data they're looking at, there was a great interview with Mary Daly. She is the San Francisco Fed president, and she pretty much just laid it out what they're doing as far as like the documents they're looking at, the numbers that they're looking at, and she's talking about how they're not looking retroactively. They're looking forward, which I kind of have to doubt here. But the Fed pivot is just that, is what we're hoping that the Fed will pivot, because the Fed pivots, that means that they were, instead of increasing interest rates, they will become stagnant, not raise or decrease. That is what the Fed pivot all is about. And that just takes care of the first part, the PPI numbers. So the next part is this, the Fed pivot, why it won't take immediate effect. And I need to, and this is going to be a little tricky, so hang with me for a second. First of all, actually, that Mary Daly video, the Fed president. There's a link in the description. You can find that to that video. It was like a 30-minute interview, but I chopped it down to 12 minutes just to give you guys the highlights. But there was a piece that came out about the Fed pivots. When the Fed pivots, stock crash a little bit more. And not that everything remains the same. I know I'm always talking about this. These people say this time is different. It's never really different. Although, if we take a look at the macro events, if we take a look at years, not weeks, it really is the same thing, just repeating again and again and again. But from weeks to week, from small time frames, there are some variances. And what I want to focus on is first this great financial crisis. This is between 2007 and 2009. There's a lot of things going on at that time. There was high inflation. There was default swaps. There was the housing market crash. And we felt that for quite some time. And between this time frame, even when the Fed pivoted, when they stopped raising rates, it took 18 months till the bottom. The dot-com bubble crashed between 2000 and 2002. After the Fed pivoted, it took 21 months to actually start hitting the bottom and go back up. Gulf War recession, 89 to 90, took 16 months. Double dip recession, 81 to 82, 13 months. 1973 recession took 11 months. And 1969, not bad, 3 months from the time when the Fed actually pivoted. So if we're looking at these time frames, this could be kind of concerning about how long it can be. And what we're talking about here, let's just take this part here. August 2007, 2009, the great financial crisis. So first I need to back up. Because if we're taking a look at August 2007, let's back it up all the way to 2004. And what I want to take a look at is the federal funds. Federal funds effective rate is just an average to the actual federal funds rate. And you can see here that they started to increase the funds rate starting around 2004, June 2004, just like what they're doing now. They're raising rates because they want to squash inflation. What was happening around June 2004? Well, if we take a look, and this is also linked in the description, in 2004, this is the inflation rate. I don't know if you can see this that well. It's a lot of numbers here. 2004, this is January, 1.9. Not bad. That's exactly what we want, 1.9, 1.7. Then all of a sudden, it started to go up, 2.3, 3.1, 3. That's a little bit hot. So January, February, March, April, May, June, July. And you start to get a bunch of threes. So we take a look back here, the federal funds, what happened here? April 2004, May, June, July. And they started to raise the rates because they're like, we don't like these numbers, these inflation numbers. And they started to raise. And then in 2005, it still took them time. Inflation rate was threes, 2.8, 2.5, not too bad, 3.6, 4.7, 4.3, 3.5, 3.4. 2006, 4 is 3.6, da, da, da. And then right around January, February, March, April, May, June, July, August, September, October, August, September, October, it started to really go down, 2.1, 1.3, 2.0. Not too bad in 2006, but there's still a little bit of problems here. So what happened back over here? 2006, February, March, April, May, June, July. They said, okay, let's take our foot off the gas. July 2006. Okay, inflation's going down. Let's just become stagnant. And they pivoted right here, July 2007 to August 2007. What happened over here? August 2007, January, February, March, April, May, June, July, August. It was 2.0. Like, okay, things are going good. We'll be okay. They pivoted, and then here's what happened. They started to reduce the rates, and that was okay. And then there's this gray area. I'll get to that in a second. But what happened around December 2007? Well, we take a look at the S&P 500. In December 2007, this is the historical trend of the S&P 500. And you can just see how much it just went down and down and down. Again, what is this gray bar right here? Well, it's very simple. That's a recession. So Q4 2007, that's when officially the recession started. I think it started before that. But even when the Fed pivoted, and this is just one example I'm giving you. You can take a look at all the other ones down here and verify it. But even when the Fed pivoted, how long did it take to get back up? 2009. So again, that would be in line with here, February 2009. Took 18 months for the bottom. than to actually recover. And then more bad news, folks. This is from Nicholas Merton. I believe that's Data Dash. Good guy, great channel. I've watched every so often. And he says, hey, for the first time in 14 years, the NASDAQ composite had a weekly close below 200-week moving average. Let me say it again. For the first time in 14 years, the NASDAQ had a weekly close below the 200-week moving average. This was a pivotal moment for the two prior 50 to 80% bear markets in 2000 and 2008. Bitcoin hasn't lived through that, but it'll live through it. It'll go through it. So here's 2000, and look what happened to the S&P. Burp, or NASDAQ, excuse me. Here's 2008, and look what happened. Burp, went down farther. And here we are in October 2022. So if history repeats itself, which it may not be perfect, I don't know how low we're going to go, we could see a little bit more of a downside. So having said all that, remember, there's little differences between that and the macro events that happened back then. I mean, our inflation rate's a little bit higher, that's for sure, right? Subprime mortgage and things like that doesn't go on as much, but we still see the macro events that are playing out right now, right? Bank of England just had to start printing money. And they said, look, you guys got 3 days to fix this because we're shutting the printers off. Or we're going to stop buying bonds, essentially. And who knows what's going to happen there. We see that the inflation rate hopefully has cooled a little bit, not for sure, but there's some problems about. And then, of course, we see an energy crisis in the UK and the things that are going on over there. Also with Ukraine and the war, which causes uncertainty in the market. So I'm not saying that this is going to happen perfectly. I'm just saying there is potentially trouble afoot. So here's the good news. The good news is this. I've talked about this before on the channel. There's a reason why right now I'm not freaking out. I haven't really only changed the voice, the tone. It's the same thing. It's just over and over again. Same thing to me, over and over again. I know some of you are a little bit worried, and I understand why, but we knew it wasn't going to be easy. We knew it was going to be a tough ride. We knew we had to get through this to get to the promised land of the next bull market. So are you really surprised? And if you are, it's okay. Just stick around because nothing really surprises me these days. Here's the thing. If we take a look here at the recessions last 12, 18 months, somewhere around there, right? But you have to look in between. This is all economic boom right here. So after that dot-com crash, not too bad. So actually right around here, dot-com crash, excuse me. Economic boom, then the Great Recession, big economic boom, then the Black Swan event, coronavirus, economic boom, 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 right? And how long? So like 12, 18 months, right? Let's just say 18 months. Maybe it extends into 2 years. Okay. So I think there is recessionary tones right now. So let's just say that they don't call it until next year, 2023. Well, how long? If it lasts 2 years, that's okay. Because look, it's amazing how everything just kind of lines up. Like we just talked about. The bottom of the market took about 18 months. Recessions last about 18 months. So for all these time frames, in 2 years roughly, this is what I see. 4-year cycles, I think, are still in play. Could work out, maybe not. But it's amazing how if you overlay these charts, they're starting to really line up. So the first halving of Bitcoin was in 2012, and then we hit an all-time high in 2013. There was a dip and a reset. Same thing happened in 2016. Bitcoin halving, then an all-time high in 2017, then a dip and a reset. And it happened again. 2020, we had a Bitcoin halving. Then 2021, we had an all-time high. I personally thought that we would have some extended cycles and we'd see a big rally in 2022, but I was wrong. And the 4-year cycle was still correct. And we're seeing a pretty big dip, and I think we're going to go lower to a reset. I could be wrong. But what does that mean? Well, let's say the recession starts in 2023. Well, that year is gone. Just time to accumulate, sit around, maybe get a side hustle, a nice gig, do some things while you're buying up some cheap whatever you're buying. And it happens again in 2024. Well, let's say it takes 18 months. Wouldn't that put us in the middle of 2024? Let's say it takes 24 months. That would put us to the end of 2024. But what happens right after that? All-time high dip reset. But who cares? Let's say I'm totally wrong. Let's just say that this recession goes 3 years. Okay, well, it goes 3 years. For me to go through 3 years of what we've already gone through is not a big deal. 2 years, 3 years, whatever. Gives me more opportunity to do the things that I'm doing, which is following my rules. And the rules are very simple. They're right below me. These are my rules. You don't have to follow them. I don't invest more than I can afford to lose because I think it's potentially all gone. If I feel it in my mind that it's all gone, well, I won't invest more than I can afford to lose because there's major upside, I think, in this market. Everything's a scam until proven otherwise, 100% scams. I don't leave anything on exchanges anymore. At least I try not to. I get lazy sometimes. I don't use leverage, and I take profits along the way. So if I got 3 years to do these things, and I do what's called dollar cost averaging, and right now, just to be crystal clear, I'm still dollar cost averaging. I'm just not dollar cost averaging as much as I used to because I think there's more downside. But like I've said before, I'm not a genius. I don't have a crystal ball. And I don't know if all these things are going to hit. So I continue to dollar cost average a fraction of what I usually would spend. And unlike some people, Ben and the cryptoverse, I still buy alts because, again, I don't know. But I'm what I call micro DCAing. And that's the good news. And then also, if you're looking for just some other good things that are happening, look behind the scenes. Did you know, and people are going to talk about this today, BNY Mellon is starting crypto custody service. First of all, who's BNY Mellon? It's the oldest bank in the US, and they have 43 trillion assets under custody and almost 2 trillion assets under management. And this goes in line with the BlackRock, the Mass Mutuals, the Fidelities, who have trillions of assets under management getting into crypto as well. And when is the good time to get into crypto or any investment? When it's really super low, so you can scoop it up when everybody's scared S-less. They don't want to invest. So this is what's going on. BNY Mellon starts custody service. It's not a big story. BNY Mellon will now be able to provide fund managers with storage of the keys necessary to access and move around their Bitcoin and Ether, as well as the other traditional bookkeeping functions. And I think that fund managers, institutions, they're going to get more into Bitcoin and Ether because I think Gary's going to not classify those as securities. And that's going to be the big headache. But I could be wrong. And that's what we got. So look, that's it for today. And a little bit long. Sorry about that. But that's how I see it. I know like there's some scary times ahead. I got that. I know. But to me, this is just like a repeat of 2018, 19, and 20, just happening again. And here we go. I could be wrong on the time frames. Maybe it takes a little bit longer. Maybe it's a little bit less. But I'll still be here for the long haul because I think there's a massive asymmetrical upside to crypto as opposed to traditional markets. I'm not a financial advisor, and this is just things that I do. So let me just think about that in the comment section. Now, if you've got time to stick around, great. We'll do a little Q&A. I'll answer all your burning questions to the best of my abilities, and we'll go from there. If you got to take off, take off. I appreciate you stopping by and hanging with me for 18 minutes. That was pretty cool. But that is it. So we'll do the Q&A. And also, so everybody knows, I made a promise yesterday I was going to do more staking videos about how to stake. Because, I mean, the crypto that you have is just sitting there. You might as well stake it. And you might as well do a safe version of that. So I want to tell you how to do those things that I'm doing. But that's it. All right, now let's get into a little Q&A and we'll go from there. Let's see.